This was 2 years ago. I walked in the door. I created 300 grand in net profit in the first 3 weeks just because we know how to optimize things.
Welcome, everyone, to another episode of What's Working in E-Commerce. My name's Eagan Heath. I'm the owner of Caravan Digital. We're a direct-to-consumer e-commerce marketing agency. Today, I'm speaking with Matt Putra from 8X. Matt is a CFO, a fractional CFO for e-commerce companies. Matt, welcome.
Thank you so much for letting me be on the show.
Yeah, really excited to have you. What is a fractional CFO? What sorts of things are you doing for clients?
You got it. So the mission for us is to help people scale their companies with more cash and less stress. That's the mission. That's the goal. You're here. You want to get to the next level. My job is to help you resource that and not break things along the way.
Yeah. What the piece about fractional, I know probably larger companies have dedicated CFOs, maybe in e-commerce, is it the revenue is smaller and so it makes sense to have a fractional person? Tell us a bit about that role.
Yeah, you got it. So there's a bunch of fractional CFOs out there. Most of us have been actual CFOs full time for organizations, some not. And the reason you'd hire a fractional is because you don't want to pay 250 grand, 300 grand for a full time CFO. And I would say that companies up to even 100 million could probably do 100 million in revenue a year could probably do with a fractional. It gets dicey at the upper range, but I work with a company right now doing mid 8 figures, and I'm fractional 2 days a week only.
Very cool. And give us a sense of the day-to-day of what sorts of things are you working on and helping, e-commerce brand owners with?
Of course. So as you can imagine, because we're very much part-time, we're working at a very high level. So we're helping a company with cash planning, kind of the financial roadmap to get to the next level, whether it be an exit, doubling in sales, what have you, or even sometimes we're helping a business turn their thing around. And so most of us, what we're going to do is we're going to come in, we're going to review your records and your books and talk to you about your goals and really make sure we understand where you want to go. Then we're going to help you create a plan to get there. And we're going to help you create a plan to mitigate the risks that might show up along the way, whether it's, bad hires or changes in margins or market effects. And we can't predict the future. But really it's the planning. It's the helping someone understand their numbers, helping someone get clarity. One of the big things I think for me is why I started this is because a lot of business owners, because of the uncertainty, cash, where things are going to go, it's just stressful to run a business. And there's a lot of ways that a lot of things we can do to help somebody reduce the uncertainty. One of the core ways for me is the one thing we know about a financial forecast is that it's not going to turn out the way the one forecast says it's going to turn out. So what we like to do is we'll do kind of our core expectation forecast. We call it a base case. Then we do a best case, which is like if everything goes really well, this is what things are going to look like. Then we do a worst case, which is where I say, well, what if we don't sign this client? And what if this hire doesn't work out? And so what the hope is that reality is going to be caught between those three scenarios. And when you do three scenarios, you have a plan to mitigate even the worst case. And so when I can show somebody a plan where this is the worst case, this is the best case, and here's how we're going to manage each scenario, it reduces a lot of the uncertainty. Not everything, but it helps them sleep a lot better at night.
Interesting. And what happens if a brand owner does not do this sort of planning?
I mean, one of the bigger ones is suboptimal decisions, right? You make decisions based on what you see in front of you today, because at the bigger sizes, over 1 million or 2 million, there's too much going on to do it all in your head. At 200, 500,000, you can basically do the math in your head all the time. But once you get above that number, it's just too hard to do the math. So you're kind of guessing at what might be the right decision. You're making decisions based on what you see in front of you today, when there might be a key hire you need to make 2 months from now, but you've spent the money on that one project, or what I see most of the time is people are just stressed, and dealing with uncertainty is, it's just causing, like they work too much. One core problem is people taking bad loans, because again, they don't have a really great handle on their numbers and they don't know where to find the money. And so when they hit a cash low point, they're like, I got to go find anything. And so they take money that's, I wouldn't say predatory, but it's bad money, right? Interest rates really high, repayment terms are really, really high. That's actually one of the biggest things that I see is when people don't forecast what the 6 months ahead look like. I might be able to tell you that in 6 months from now, you're going to need a loan. But when you have 6 months to prepare, you can go get nice money for the most part. But if it's, if you're at month 5 and you need money month 6, you have to move fast. You don't get good money when you have to move fast like that.
That's interesting. So it sounds like it could just be a stress thing of we don't know what the future holds. We don't know what to do with
Mm-hmm.
resources or what happens in a
Mm-hmm.
pinch. Could
Mm-hmm.
also be it could hold back your growth if you're not being strategic and planning ahead. Is that right?
Well, absolutely. And I mean, there's a case where I had a client and I built their forecast. And I was like, hey, just so you know, the forecasts indicate that this business model is not going to work ever. And so we're helping them now pivot a bit on the business model, add new business like sales channels in which turns the forecast around. Now we have to turn it around in real life too, but that is actually happening. So I can really help people understand the impact of decisions now and how they look into the future. Um, but yeah, I mean, growth, turning things around are core.
When you said for that client this isn't going to work, is that based on their margins? Is that based on fixed costs, advertising costs, all the above?
Everything, yeah. So when we build a model for somebody, we are looking at everything in the kitchen sink. So we're looking at your prior sales, we're looking at your margins, your products, your advertising, your channels, everything. We're putting that all together into a forecasted income statement and cash flow statement, right? Super important to know they're not the same thing. And so based on what we saw, the margins and the way that the ad spend was going, it was just not going to work. And so we turned off one channel and we turned on another, and we hired a new agency, and things are starting to look really good. Now we're working on alternate sourcing for the product. And when we lock this down, which we're almost there, they are going to be breaking even in the next 2-3 months. So very, very exciting and rewarding for me, and obviously for them too.
So they had been upside down and now they're righting the ship because of the work you're doing, right?
Well, yeah, absolutely. We had another one where, again, not making money, margins were terrible. What we did was we looked at the sales channels individually. So if you can think of a profit and loss for the business, we did a profit and loss for each sales channel, and we found out that 3 of the 8 of them were incredibly unprofitable and dragging the whole business down. So we turned those off. They went from -4 net profit to plus 14% net profit in 6 months.
Yeah, and that could be the difference between you last as a business and you don't, right?
100%, 100%.
Yeah, man, I know you have some spreadsheets that you go through or
Mm-hmm.
some calculators. Is it time for us to pull those up? And some people are
Sure.
going to be listening, so maybe we can kind of describe each line and what it
Yes.
does and how it figures into the bigger picture. I'm a big picture guy. I know you have to do detailed work for what you do. So
Mm-hmm.
as we talk about this, I may have to come back out of the weeds a couple times and just
No
say, okay,
problem.
what's the broader import of this? But
Yes,
I wonder if you could talk us through the numbers and how you do an analysis like this.
absolutely. Should I share my screen as well?
Would love to see it. Yeah. And if we can kind of describe for people who are listening as well, if
I
you
can
are
do that.
listening to this, check us out on YouTube if you actually want to watch Matt go through this. But yeah, Matt, thank you. Really appreciate you bringing this detailed sort of calculator here. And I think you said is this available for people or how does this work?
Yeah, so I will send you this and the other file if we get to both, but if not both, I'll send you both anyway. So your audience
Okay.
can have access to these. Within these files, I have instructional videos on how to use them as well. So you can kind of open them up, and then you don't have to like rewatch the podcast. You can watch these other videos. So the one I have on my screen today is one that I've used a lot, and especially with bigger brands, especially when they have kind of targeted monthly results or quarterly or annually. And so what we're trying to do, of course, with e-commerce, a lot of e-commerce is obviously dependent on ad spend and dependent on blended ROAS or MER. And the thing that I wanted to understand and where this came from was someone had a budget. They wanted to make X dollars in this quarter or year. And what we don't know is what is your blended ROAS going to look like across the year. Now, stepping back real quick from the CFO CEO chair, my point of view is there's only a few core numbers you want to look at, and blended ROAS is one of them. As a CFO, I don't need to know how each channel is doing. I don't need to know the new customer CPA or new customer CAC. I need blended numbers. Here's why. I need to manage cash flow and profit, and so I need to know how much is ad spend as a percentage of net revenue. I don't I don't care. I want it to improve, but I'm going to tell the CMO or the ads team, hey, this is where it is today. Here's where I want it to get to. And they need to figure out all the mechanics of that. But from the CFO seat, I got to manage cash flow and profit. So this sheet in front of us is a table of potential net incomes for a given ROAS across the top and a given ad spend across the left. And when you combine, well, you can just triangulate, right? So let's say for this particular client, they're going to spend 1.4 million and they're going to get a ROAS of 3.81. So you can triangulate that they're going to make 300,000 on the year. So I'm going to back up and I'm going to show you a couple of the inputs, and then I'll come back to this table and then explain a bit more about how it works.
Great. Yeah, because I assume this is based on margins and things like that, right?
Absolutely, yes. So on the left, you have inputs here. Now, for those that are watching and those that are listening, anything where you see blue text, you can overwrite. If it's black, just leave the cell alone. So when you look at this income statement, you're gonna input your either your budget or your prior year income statement to help you get a better view. You can do both. Both will help you understand your business better. So this company, fictional company, has $5 million in D2C sales. They have $2 million cost of goods sold for a gross margin of $3 million, 60%. Okay. Then we put a section where we put in our variable operating expenses. Now, these I want variable only. So there's a line for marketing spend. You don't put your agency. You don't put your Klaviyo. You don't put your software. This is variable marketing spend. We have outbound shipping.
As
Sorry,
in, that's marketing spend is ads on Meta ads, ads on Google. Is that right?
yeah, Meta, Google, TikTok, Snapchat, wherever you spend money, and the money would increase as sales increases if they're like connected. It's anything variable. So outbound shipping, the same. Outbound shipping should go here. Payment processing will go here, and you're just putting in the dollar amounts. And the reason why we're putting the dollars, not the percentages, is because most of the time our estimation of the percentage is incomplete, meaning um, theoretically we know that our shipping should be about 10% of sales. Why do we know that? Because we know our AOV is this, and we know what it costs to ship an order out. Don't do it that way for this analysis. Um, when your bookkeeper's putting everything together, they're getting all the sources, all the transactions, everything. And there's just stuff that we miss in our brains. So it could be 10 to ship an order of AOV of $100, but you're going to miss something. You're going to miss a duty. You're going to miss a, I don't know, one-off charge, returns something. So use your QuickBooks or your Xero or what have you. So once you get in all your variable expenses, we move to the next step where we put in our fixed expenses. So put in your agencies, your payroll, and then all of your overhead here. And again, anything blue you can overwrite. You can change these names as you need to, but you don't even have to put in the detail. You could just put in one big number for all your fixed expenses. And then what this is here, this is either going to be your budgeted target for the year if you're using a budget, or it's your actual net income from the prior year. And again, like I say, both will help you understand what to do. Now, what this is doing is it's going to calculate on my screen here. It calculates your MER, which is very simply your variable marketing spend divided by your net e-commerce sales. In this particular company, it's 30%, right?
You're calling
So,
that
mhm.
net sales. So you're going off C10 there. That's top line. That's revenue, right?
Revenue, yeah, yeah, and that's the
Marketing
way that I
spend.
use MER. I'm aware that some people they calculate it a little bit differently, but
Mm-hmm.
for me, I use it marketing efficiency ratio. It's total
Yeah.
ad spend divided by total applicable revenue. Now, you don't. What you wouldn't do if you have wholesale revenue, you're not going to include that in your MER because it's not related, right? So on an MER of 30%, ROAS is the inverse, so it's just 1 divided by MER. So now what this table can do is it tells you, let's say you're looking at your prior year. Well, what would my net income have been like if I had either spent more or ROAS was different? And so this could help you understand the impact of marketing initiatives if you're using this for a prior year. So we spent 1.5 million. So what would my net income have been like if I spent 1.5, which is here, at the 3.33 that we got last year? We can see it triangulates to 55,000, which also matches 55. But what if my ROAS was just a little bit better? So go from 3.33 to 3.48, not a big jump, but a very big jump in net profit. We can see how it changes to 149 here. What if we had the same ROAS and spent more money? Yeah, you'd make more money. So if you spend 1.6, you're going to make 100 grand instead of the 55 you made. But what I want to do this is I want to show people that the impact of efficiencies, the impact of, even pruning poorly performing ad campaigns out of their account, you can have a small bump in ROAS just from that. And so what if last year you let some poorly performing campaigns run? You might have left 100,000 on the table, this fictional company, right? What if you test a few more offers and things like that? What if you can get your ROAS up by even half a point? So this is just 15, 15 small points. What if you can get to 3.8 instead of 3.3? A change like that is definitely accessible by most companies. And so then you're making 300,000 more than you thought you'd make. Now, if you're using a budget for this, you can test your sensitivity to your budgeted plan. This company is planning for a 3.33 blended ROAS. And if they do what they want to do, they're going to end up with 55,000 in net income. But if they can tighten it up, do better, they can see where net income might land. Now, one of the problems that happens sometimes is your budget, your first version of a budget, gives you a net loss. So let's say, for example, I'm going to spend 2 million. See what that does. Okay. We can see now that we're losing 500,000 if it takes 2 million to get 5 million in sales with our other uh, cost structures. So now we can see that we're losing 400,000. So now we can ask the question, what is it going to take for me to break even? What do I want to do? So your target, let's say, is now positive 100,000 here. What do I have to do to get to 2 million? Well, this thing will show you. So you can look and see your ROAS is 2.5. So it's over here at a spend of 2 million. So what do I have to do to break even? Basically, I either need to spend a lot more money or I need to improve my ROAS. And there's other ors as well. What if I can cut my overhead? Okay. So you can cut your overhead as part of the things you can do. So let me back these changes out real quick. So now we're back to the former scenario. And again, you can see if you're able to reduce your variable costs even by 1%, you make another 50 grand. So all of these, and it makes it easier to break even. It makes it easier to scale your company. So this tool I have found very useful, and a couple clients of mine also like it because again, it just helps you understand the impact of decision making on your net profit.
Yeah, I appreciate that net profit is the focus of revenue is vanity, profit is sanity. What do you actually get to keep?
That's right.
And then also how you walk through, can we get higher ROAS? Can we spend more? Those are the two, axes we're seeing on this graph. But as you said, if we can make our operations more efficient somehow,
yes,
that moves the needle almost more in the sense of same sales, better profits. That could get us there.
absolutely.
If we're not profitable, that could make us profitable. If we are profitable, that could make us more profitable. Love this. This is awesome. And on the far left, one thing that was very helpful as you went through this was even just thinking of cost of goods sold versus variable cost versus fixed cost. Oftentimes when I've seen these, or even sometimes when we're going through, something like this with our clients, we're sort of thinking fixed and variable, and then there's this whole confusion of what's what. But you even got this third category that makes it even more clear. Can you just talk high level for a little bit of, what counts within COGS, what counts within variable, and then what goes in fixed? Just give some examples that you've seen.
Absolutely. So I have a method that I love to use for cost of goods sold and for variable, and I'll give it to you, of course. So cost of goods sold, we all know, most of us someday want to sell our companies, and or maybe we need to access debt or equity or what have you. So I want our gross margin to look as healthy as possible, which means most companies I work with have too many things included in their cost of goods sold. What I like to have in there is this: product costs, inbound shipping, customs and duties. That's basically it. That's the only thing I put in there. I see payment processing. I see outbound shipping. I see other variable costs included in there. Don't do it because it makes the difference. Like when someone looks at your income statement, if you include all of those things, your cost of goods sold could look like 50%. If you remove the things that I just told you to remove, your cost of goods sold could look upwards of 65%. What do you think looks better to an investor? What do you think? I mean, you're not fooling anybody. They know you have other variable expenses. But as a headline gross margin, I'd rather show them 65%. The company looks more scalable, right? Now, again, you're not fooling anybody, but that's the way I prefer to show it. And most accounting standards, and I can confirm UK, Australia, Canada, US, allow for the way that I like to do it, and they think that it's fine. Now,
Yeah.
in variable operating expenses, marketing spend. This, I mean, really, you're looking for anything that changes sort of either linearly or non-linearly with revenue. So anything that changes with revenue, payment processing, outbound shipping. Every time you sell an order, you have to pay outbound shipping. That's variable. Some people have signed up for 1% for the planet, that donation thing. So every time you sell something, you have to pay this organization 1%. So anything variable. It could be affiliate commissions. It could be influencer payments. It could be if you pay for your customer duty, it would be outbound duty payments. Anything variable should go in here. For some people, sales commissions for sales reps would go in here. And so the reason you want to very closely monitor your variable expenses and your cost of goods sold is because a very important metric for people to watch is called contribution margin. It is a measure of how many cents are left over after you remove every variable expense from $1 of revenue. So I'll just calculate it quickly here. And I call it contribution margin, and I call it 3 because it just means what's left after every dollar. So we have gross margin minus variable costs of this. So that's your CM3. And as a percentage of sales, it is 13%. The targeted CM3, I would suggest for non-Amazon Shopify D2C wholesale, you want to be targeting 20 to 30% CM3. That means that if you sell $1 to somebody, 30 cents is left over to cover fixed costs and or make you more money for profit. 13% is too low. My preference, like I say, 20 is what I would say is the lower limit for CM3. And some people have said, hey, my CM3 is 30%. I want it to be 40. And my answer to that is, no, don't do that. Just go get more customers. At 40%, you are leaving money on the table, where you could just get more customers and have more repeat purchases and things like that. So this CM3 is too low, but again, that's a fictional kind of setup scenario.
Just to recap on this for anybody
Yeah.
listening or watching, then is you're not looking at top revenue, you're looking at gross margin, and then you're subtracting out variable expense. Did I have that right?
Correct. Yes, definitely.
Yeah. And maybe give us a sense too of what is the I know that's a very important one. Tell us why that's such an important one.
Yeah. So this, I mean, your company is going to grow or not grow because of this number, right? So you can imagine. Here's a way to show you, and I'll explain this for people who are listening. So if you have fixed costs of 100,000, and if you get to keep 13 cents of every sale, I'm going to tell you what is your break-even sales. You divide your fixed costs by your CM3, and it gives you your break-even sales. For this fictional company, again, even the second fictional company, on the screen, dividing 100,000 fixed costs divided by 13% contribution margin, break-even sales is $700,000. That is a lot. Okay. If
I'm going to just say it in human language here if I can for a second. Not accounting language, but just put it in an English sentence, and you tell me what I get wrong. Okay.
Yeah.
It's contribution margin is getting us some sense of, based on how much we spend, how much are we actually going to get a keep out of the sales that come out of that? Did I say that right?
Yep, you did.
Mm-hmm. Okay.
Absolutely.
Thank you. Just keep going. I just want to make sure I get the bottom line.
No, sorry. I fall into the trap sometimes of talking like an accountant. So I set up a sort of a second scenario here where the CM3 contribution margin is 20%, and applied against fixed costs of 100,000, your break-even sales level is now only 500,000. So imagine how much less effort it's going to take to get there. Um, and it goes both ways. So the lower your CM3, the harder it is to break even. The better your CM3, easier it is to break even. And then you can also lower your fixed costs, which again is hugely important. The rule of thumb that I give people: every dollar of fixed costs requires $4 to $5 of revenue to cover it. So be very stingy with fixed costs. In this scenario, if we change our fixed costs, if we reduce them by 25,000, look how much it changes. The revenue changes. It went from 750 to 550 by removing 25 grand of fixed cost. That is hugely important for people to notice. On the other side, where your CM was 20%, it changes a bit less because you're more profitable, but fixed costs have a very, very large impact on people's companies. And this is actually one of the things I see the most is just add too many fixed costs.
We had a client for many years that they're selling pretty low AOV products. They were running their own warehouse, just that's how they were doing it. And those fixed costs, they're kind of their monthly nut they needed to make. It was very high, and it made things very difficult in terms of growth. And so this is a big aha. I can think of someone right now, a former client who needs to watch this and go through exactly what you saw here. So thank you so much, Matt. Is there more to this we should be thinking about? Is the contribution margin that percentage then, or that number, that dollar sign of 675,000?
In this scenario, yes, this fictional company's contribution margin from this side is 675. And you know what I'll do is I will modify the sheet a little bit, and I'll put this down here, and I'll also add the break-even calculations just below for people that might receive this sheet later. One thing I'll say, just to highlight how conservative I am on fixed costs, is I have a client who just raised multi-7-figure venture round, and they wanted to lease an office for 4 or 5 grand a month. Not that much when you compare to a 7-figure raise. And I was like, I think we should be looking at a WeWork. It'll be $1,000 for 2 desks for now. When you get to the inflection point of it being 5 grand, then go to the office. But for now, wait on the fixed cost. And it's a very small number, but I know that on $1,000, I need 4 grand to cover that. But on a $5,000 office, I need 20 grand. And so what would I rather choose? Be as conservative as you can be, especially this year until the economy kind of recovers, because we know the banks are failing. Lenders are being so tight with their money. Investors are also being tighter. And so you just have to be careful. And right now, consumers haven't necessarily changed their buying behavior. We don't know if they will or if they won't. But if they do, all these decisions matter.
Yeah. Wow. This is phenomenal. Thank you, Matt. I'm very curious, when someone starts with you and you ask, what's your gross margin? What are your variable expenses? What are your fixed expenses? Do they ever say, we don't know and we don't know how to find out?
Sometimes they say we don't know. And I think to credit of most people are very humble about things, and they want to work with me because they know that we know what we're doing. And so they say, look, we think it's this, but can you double check it? Is the comment I get the most. And I would say by and large, most of the time when I check it, it's different than what they think it is. Just because, like I say, the financial statements have duties, taxes, everything is in there, where in your head, you just can't hold that many variables in your head.
You have to model it out. What happens if return on ad spend changes?
Exactly.
What happens if our amount of ad spend changes? What happens if our expense changes? All of those affect everything you're talking about here, right?
Exactly. 100%.
This is excellent. Matt, I know you have a cash flow one as well. I'm greedy and eager to go through it. Maybe we should make that a separate episode. This has already been a total masterclass. These are some things I've been wondering about sometimes when we're talking with clients, and these are questions we don't necessarily know how to answer for our clients. So maybe let's make this part 1 right here.
Sure.
Can you tell people a bit about, who's a good fit for you and where they can find you?
Absolutely. So you can find, I have some links in here, but 8x.co is my very horrible 80s looking website. If you want to interact with me, find me on LinkedIn, MattPutra. I post on there pretty frequently. I also respond to DMs and comments, and people request phone calls. I jump on a lot of phone calls just to check in and chat. You can also just email me, Matt at 8x.co. Who am I a good fit for is a great question. So we do bookkeeping. So for bookkeeping, we can work with anybody. Our bookkeeping is very, very good, um, very affordable. So we can work with anybody. On the CFO side, doesn't make sense for everybody. It's not super cheap. But for the CFO side of things, I would say if you're between $2 and $80 million in revenue, we can help. Um, I walked in the door of an 8-figure client. This was 2 years ago. I walked in the door. I created 300 grand in net profit in the first 3 weeks just because we know how to optimize things.
There it is. Wow. That's exactly what I wanted to have you come on and speak about. So, Matt Putra, thank you so much for coming on and sharing what's working in e-commerce.
Thank you so much, Eagan. This was great.